I did not start investing until later in life because I was not comfortable with it. I did not know anything about it. But here are 7 quick tips that I learned along the way that helped me to be more comfortable with investing so that I was not scared to get started. Tip number 1, start early. Time is your greatest ally with investing due to the power of compound interest. The earlier you start, the more you'll benefit from this, even with small contributions. Now, the example that I use to teach my kids about compound interest is the doubling example. You ask them, hey, if I hired you for a job for a month, would you rather take $10,000 for the month, or would you rather that I start paying you 1 penny for the first day and then double that each day, increasing it every day? Now, by the end of the first week, you tell them, hey, you'd make a whole 64 cents at the end of the first week. Now, you can continue with this doubling, or you can take the $10,000. Well, at face value, the $10,000 looks a lot more beneficial. But if you carry that out all the way through the month, you find out that at the end of the month, you're going to get paid over $5 million. This is the power of compound interest. Now, your investments aren't going to compound like this, doubling each day. They're going to grow at varying rates. But this gives you a really good idea on the power of compound interest. Using compound interest, you could feasibly turn your children into millionaires. If you were to take $3,000 and at the birth of your child, put that into an investment that is slated to gain at about 10% per year, such as the S&P 500 does. And then by the time they turn 62, they're going to have right about $1 million in that investment account without ever adding another dime to it. This is the power of compound interest. Now, tip number 2, diversification is key. Spreading your investments across different asset classes such as stocks, bonds, real estate, this reduces risk. A well-diversified portfolio can help smooth out returns over time. This is the whole adage, don't put all of your eggs in one basket. It's just like food choices. If you want to have a well-balanced diet, eating a variety of foods like fruits, vegetables, grains, and proteins ensures a balanced diet. Taking a little bit from here, a little bit from there, when it comes to your investing, will make sure you have a well-balanced and portfolio that will provide you great returns over time. Tip number 3, understanding risk and reward. Now, higher potential returns come from investments that have higher risk. It's important to find a balance that aligns with your risk profile and your investment goals. Now, all investments come with risk, and with financial risk, it is usually tied to that reward. This means investments with potential to return the most usually have the potential to lose the most. And safe investments don't typically return much. This is very much like a roulette wheel. On the casino floor, if you're going to bet on either red or black, well, about half of the board is red and about half of the board is black. So it pays out 2 to 1. You put your bet down, if you get black, you get 2 back. Now, if you go with higher risk, say bet on one of the numbers 1 through 36, there is a much smaller chance that that one number is going to come up. But if you do happen to get it, hey, you get 36 times your bet back. But if you don't get it, you get nothing. Tip number 4, invest for the long term. Short-term market fluctuations can be volatile, but a long-term approach helps you ride out these ups and downs. Patience and discipline are vital. And while it may pay to stay invested, stocks are generally more volatile than fixed income, and returns can vary greatly from year to year. As a result, stock investors may be tempted to abandon a long-term strategy. So, while past performance doesn't guarantee future returns, history has shown that it's been beneficial for investors to stick to a plan and stay invested for the long term. Steady growth is an exception in investing, not a rule. You're not going to see a steady growth over time with just a straight line in your investing. It's going to go up and down. So you should consider patterns of returns over the last 20 years and not be thrown off by a market's short-term ups and downs along the way. Tip number 5, keep costs low. Fees and expenses can significantly erode your returns over time. Opt for low-cost index funds or ETFs to keep more of your money working for you. Now, an example of this is if you were to take $2,000 and invest it in a fund that was expected to receive 10% returns over time, and you left it there for 20 years. You didn't add anything more, you just left your $2,000 for 20 years. If it did indeed earn that 10% per year, after 20 years, you'd have approximately $13,455. Now, if this fund was to have an additional 0.5% in fees for maintenance, that would wind up with, after those 20 years, a result of $12,201. This is $1,253 less just from that 0.5% over those 20 years. Now, to put this in perspective, the additional cost reduces your final value of the investment by about 9.3%, and it decreases your total returns by approximately 11%. So fees over time can really add up. So keeping those costs low is key. Tip number 6, stay informed and avoid overreacting. While it's important to stay informed about your investments, avoid making impulsive decisions based on short-term market movements or news. Stick to your long-term plan. There are a lot of crazy headlines out there that can scare you. Things like stock market crash, COVID-19 pandemic triggers global sell-off, GameStop short squeeze surprises Wall Street, China's 2024 stock market crash deepens economic woes. Article titles like this are designed to scare you. The news outlets want you to react. They want you to make bad decisions because that makes good news. If there's a lot of volatility in the market, it gives them more to report on. But with informed decision making, a great long-term plan, you're not going to react to these articles. You're going to stay in the market and you're going to benefit from those long-term returns. And finally, tip number 7, regularly review and rebalance your accounts. Periodically review your portfolio to ensure that it aligns with your goals and risk profile. Rebalancing ensures that you maintain your desired asset allocation. When or how often should you rebalance? Well, the research shows that optimal rebalancing is neither too short, such as monthly or quarterly, nor too long of a time horizon, like every 2 to 3 years. Most investment professionals suggest that you rebalance your account, which means ensure that, hey, if you wanted 20% in bonds, 50% in stocks, and 30% in real estate, you look at that annually. And while stocks may grow and bonds don't grow as much and real estate stays about the same, so you'd rebalance because you wind up with 40% in stocks and 10% in bonds. Or however, you rebalance to the asset allocation that matches your risk profile annually. With a little bit of knowledge, you can really feel more comfortable with investing and really grow to the future, because you don't get rich so that you can invest. You invest so that you can get rich. Now, if you want to learn a little bit more about investing to see how much you're going to need for retirement, check out this video right here.